All right, well, good afternoon, everybody. Hopefully coming through nice and clear now. I appreciate you all taking the time to join us this afternoon for a bit of a budget review, just to go through what was discussed or what was proposed in last night's federal budget, handed down by the Treasurer, Jim Chalmers. So, first and foremost, welcome. Thanks a lot for coming along. A bit of housekeeping today. If you have any questions at all, I would ask that you hit the little chat balloon down the bottom of your screen and pop your question in there. I'll do my best to answer any and all questions once we wrap up at the end of the session today. If there's anything that I don't have an answer for or we don't get to, I will reach out to you after today to respond accordingly. Rightio, so let's get into it. So I'm just going to share my screen. But yeah, it's the 2022 federal budget update. Normally we have these in May after the annual federal budget, but obviously because of the election that was only held a couple of months ago, the new government needs an opportunity to pull together their plan of attack, and that was what was presented last night by the Treasurer. Importantly, what I want to note today is that what I'm going to talk through is general in nature only. So whilst you might have your own personal individual circumstances, what we're going to talk through today doesn't take anyone's individual circumstances into account. So if you are going to make any decisions based on what I talk through and discuss today, it's really important that you speak to your advisor first before making any decisions, just to make sure that the information that you want to act on is appropriate for you and appropriate for your needs. Okay, that out of the way. So yeah, the last night was a very, I guess what we would call a safety first budget. It's almost like the Labor Party looked at what Liz Truss did in the UK a few weeks ago and said, let's do the opposite of that. There's not a lot of big spending. Government's got quite a bit of debt it wants to pull under control. A lot of that they've inherited thanks to stimulus packages through COVID, etc. Government were also quite vocal in noting they didn't want to put any undue upward pressure on inflation, which is already running high. So it's a pretty tight one. There's not a lot to get excited about, but there are a few things that I did want to cover off today. I'm going to run through a few areas. Please be mindful that these right now are just proposals. Okay, so the government's proposed a number of things, still required to pass through both houses of parliament, and then it needs to get what we call royal assent, which is where the Governor General signs off on the legislation. So please keep that in mind. But I guess the first area that I wanted to talk about is changes to superannuation rules. There's a number of things that the government talked through last night. A number of proposals that they talked through are things that have already been flagged previously or were kind of election promises. There wasn't a great deal of, oh, wow, this is a new concept or policy that we hadn't really thought of before. But the first one I'll talk to is downsizer contributions. So there, at the moment, people have the ability to take the proceeds of a sale of their home, add it to superannuation. If they've lived there for 10 years, if they've owned it for 10 years and lived there during some of that time, and they can take up to $300,000 of the proceeds and add it to superannuation. Now, initially when this rule came in, it was limited to folks over the age of 65. That rule was eased a couple of months ago, and from 1 July this year, the government said, okay, anyone over 60 can do this, and now they've eased that again, and they're planning to reduce this to be allowable for folks over the age of 55. It's expected to be effective, hopefully from the 1st of January next year. But again, it's got to get through both houses of parliament and be signed off. So either be effective on the 1st of January or possibly 1st of April or even 1st of July or October next year, if it takes a little while for this to get through parliament. A strategy like that's a great one. It's a really powerful one. It's something that we've done for a lot of clients, but I would always say that it's something that you can only ever do once. So it is important to talk to an advisor about whether it's the right thing for you to do if you are selling a property, whether you're living in it or whether it's an investment property and you've once lived in it and you've owned it for 10 years. There are a couple of proposed changes to rules around self-managed super funds as well. Currently, self-managed super funds have to be audited once a year. There was a proposal for that to be pushed out to every 3 years, but the government said last night they're not going to go ahead with that, and audits need to remain on an annual basis. The previous government had also proposed, I guess, a relaxation of rules for non-residents for self-managed super funds. And these, I guess, relaxed rules were proposed to kick in from 1 July this year, but they hadn't been implemented as yet. The current government came out last night and said they still support the changes, and they expect for that to be effective next year, again, once it passes through Parliament. Another thing that was, I guess, discussed in last year's federal budget was an amnesty on what we call legacy pensions, which only applies to a fairly small amount of the population. Legacy pensions are, I guess, what we call market-linked or lifetime pensions that were popular probably about 15 years ago for a few years, and got people, I guess, some beneficial treatment with Centrelink. Not a lot of folks have them, and they're actually quite hard to unwind and have ended up being inconvenient for a number of people. The government said last year that we'll allow you to, I guess, unlock those, but it never became law. There was no announcement made last night on this by the Labor Party, so we're kind of still a bit up in the air with that. No further update on that front. Now, the superannuation guarantee, many people would be aware that that has been increasing over the past couple of years as it moves up towards 12%. Now, now the government last night has again come out and said this is going to continue as planned. So right now, any income you earn, your employer is obliged to pay 10.5% superannuation on that amount. From next year, that'll increase to 11%, then 11.5%, and from 1 July 25, it should then be up to the 12% mark as planned. There was a bit of a talk before Labor were elected that they wanted this to be halted or paused, but it seems like it's full steam ahead now with this plan. The other thing with relation to superannuation, probably the final point on this one, is more related to folks in retirement phase who have started drawing down on their superannuation, an income stream from that. Many people would be aware that folks in retirement were able to halve the minimum that they had to draw from their superannuation pension. Once COVID hit a couple of years ago, the government softened the rules and said, look, the minimum might be 4% or 5% for you, but we can chop that in half. At the moment, that halving of the minimum rates is expected to finish on the 1st of July or on 30th of June next year, so at the end of this financial year. There's been no talk or any kind of about extending that beyond 30 June next year. So we can only assume that that's going to revert back to the norm from the next financial year. Okay. So that's kind of covering off on the proposed superannuation changes. Again, not a lot of news there, news in the things that we haven't heard talked about before, but also excuse me. Also, things going along as planned, such as the superannuation guarantee increasing and the minimum stopping, which we'd expected. Okay. The next area I wanted to talk around was tax. Tax is an important thing, obviously, to discuss with your financial planner. Also important to circle back with your accountant through any tax issues that you think might be relevant for you as well. But one of the big talking points in the lead up to this budget was stage 3 tax cuts that had been legislated by the previous government. So the previous government, just as a refresher, they had proposed a number of changes to the income tax system, whereby the income tax rates were being reduced. You can see up on the screen there that I'm just sharing. On the left-hand side is the current rate of tax that's payable, and third line down there under taxable income, the $45,000 to $120,000 tax bracket, that had previously been from 45,000 to 90, and then 90 to 180 was the next tax bracket. So stage 2 was pushing that bracket out to 120. And stage 3, you can see on the right-hand side, basically gets rid of that middle tax bracket. Sorry, not the middle tax bracket, the second tax bracket from the bottom. So basically anyone earning between $45,000 and $200,000 a year was subject to the same marginal tax rate in that bracket. So there was no commentary about stopping that. It's actually legislation that this will happen. So if the Labor Party didn't want this to happen, they would have had to repeal that legislation, which is an extra step in the process. The thing that jumps out to me with this is that this is a proposed change from the 1st of July 2024. So there's still 2 federal budgets between now and then, which is also 2 federal budgets where the current government could come out and decide they want to repeal those changes. So looks as though this is going to proceed, but it's not, I guess you couldn't say it's 100% in the bag yet that this is going to happen. Okay. The next tax issue that was worth looking at is I guess some concessions that were announced for folks purchasing electric cars. This was an election commitment from the Labor Party. Basically, it applies to folks who salary package their cars and the way that's treated for tax purposes. So traditionally, if you salary package a car through something like a novated lease, there's a thing called fringe benefits tax, which is also applicable. Your employer has to pay that to the tax office, but that'll get collected from you before they then pay it on to the tax office. Now, for anybody who purchases a battery or hydrogen fuel cell or a plug-in hybrid electric car, won't have fringe benefits tax applying to that situation, which is quite attractive. The price of the car, including GST, has to be below what's called the luxury car threshold. That threshold is currently $84,916. And the car must not have been held or used before the 1st of July this year. It also doesn't apply to anyone with an electric car that doesn't have the capacity to plug into the grid. So there can be some significant tax savings there if you play your cards right. It is something to talk to your advisor about and your accountant about. But it can be, for a $50,000 car, you could be looking at a tax saving of between $4,000 and $9,000, which is not an insignificant amount. So it's definitely something worth exploring if you're looking at electric cars and packaging that up with your wage. But it's also even more important that you talk to your accountant and your advisor about that before pushing any buttons. So it's a really well-informed decision. Okay, so that's the tax side of things. The next area that I want to explore and talk through is Centrelink. So there's a number of things that were talked about in the government last night. One thing that Jim Chalmers was really focused on was easing the pressure on families. One particular change they are looking to make is an improvement to the parental leave pay system. So currently, the parental paid scheme that comes through the government, it covers you for 18 weeks. That's for both mum or dad, depending on if you meet the criteria. Currently at 18 weeks, and they're proposing that this will increase to 26 weeks in 4 years' time. So currently 18 weeks, next year 20, 22, 24, and 26 weeks of paid leave by the financial year beginning July 2026. That rate is currently $812 a week, and it's based on the national minimum wage. So as that minimum wage figure increases over time, so will the rate of payment of that parental leave. The other change that's come in with the parental leave pay is it's basically greater flexibility in terms of how they means test your income and how you can claim it. So it used to be quite a rigid system looking at individual incomes. Now they kind of loosened that, looking at the whole household income. And also you can claim it in kind of fits and starts. It doesn't have to come in all one whack there. So that's a good little upgrade for that arrangement there. Again, if it's something that you want to explore, really important to talk. We're very happy to talk you through pros and cons and how that works to make sure you can maximise something like that. The other thing that's been brought in to ease the pressure on families is an increase in the childcare subsidy, which is going to increase from 85% to 90% of childcare fees. There's also an increase in the income test cap that's applicable to that as well, which is quite helpful. So that's helping younger families in terms of what Centrelink has proposed. The other at the other end of the spectrum, retirees and folks who are entitled to the age pension, they've also there was also some chat last night about changes that the government will make there. So the first thing I'm going to refer to is what we call the rate of deeming that applies to income, applies to your income when you're an age pensioner and applying for the age pension. So right now, any income you earn, whether it's from employment or from income and investments, the income on the investments that you earn in retirement, not the earnings as an employee. The income on investments that you earn in retirement is calculated at a set rate. For a single person, if you had say $100,000 in the bank, Centrelink are going to assume the first 56 grand gets interest of 0.25%, and anything over and above that gets interest at 2.25%. Typically, those deeming rates will increase as interest rates increase. However, the government announced last night that they are going to freeze those rates for the next 2 years, which is welcome. The deeming rates haven't really moved too much this year, even with interest rates increasing in recent months. So it's that makes life a little bit easier for folks receiving the age pension that do have investments that will kind of be deemed at these rates, which is a good thing. Another area where Centrelink will change, and what the government proposed last night, is around the proceeds of the sale of your family home. If you're kind of selling the family home and elsewhere. So at the moment, any proceeds from the sale of your home are not assessed under Centrelink's assets test. They don't count it as an asset for you for a 12-month period. Basically, they're giving you 12 months to have those proceeds in the bank and then use them for your next home. They're extending that to 2 years. So this is a good thing, gives you a little bit more breathing space. It's also a little bit more of an incentive to downsize, which the government aren't ashamed to say that. That can have a little bit of downward pressure on house prices. But the exemption from the assets test will be extended from 1 year to 2 years. And the government have also said that, look, if there's exceptional circumstances, there'll be opportunity to extend that even further to a 3-year period. This is, they're hoping this should be effective from the 1st of January next year. Now, if you are selling your home and you're between properties in retirement and the age pension is something that you're receiving, usually whilst the proceeds from the sale of your home aren't treated as an asset for a period of time, proceeds from the sale of your home do have those deeming rates that I talked about a moment ago. They do have those deeming rates applied to them. However, and if I bring back up that last screen with the deeming rates, imagine that you sold your house for $800,000 and then in 6 months' time is when you bought your new property. Previously, for that 6-month period of time, the $800,000 that you've got in the bank, it would be subject to these deeming rates. Again, there's a couple, 93,000, there's a single 56,000 is the threshold. Up to the threshold 0.25 and above that 2.25% is the assumed level of income that you will earn on that investment. Now, what the government have said last night is that, well, you know what, for the proceeds of the sale of your home, we'll treat it differently. You can quarantine that, and it will only have the 0.25% deeming rate applied to it. So even if it's above that threshold, the 56 or the 93,000, anything in excess of that threshold will not be subject to the upper deeming rate, which again can be is quite beneficial and can actually make a significant difference to what you're receiving from Centrelink and the age pension if you're between houses there. So again, that's a bonus for age pensioners there, which is a good thing. Okay. Another thing that's applicable for retiree or for folks receiving the age pension that are still doing some work is that the government also announced a temporary increase to the pensioner work bonus scheme. So not a lot of Australians take advantage of this, but if you are doing some work in retirement, you're able to earn some income and without having that impact what you're getting from Centrelink. Effectively, Centrelink let you bank some money that you've earned for future use to offset the impact the income you earn might have on your entitlements. And they basically said, look, you can bank an extra $4,000 in this financial year if you wish. So Again, not a lot of folks that applies to, but if it does apply to you or you think it does, again, it's worth having a conversation with your advisor about to see if there's anything you can do to take advantage of that. Another thing that was announced last night for folks receiving the age pension is that if you do earn some income, whatever the source, and it does take you over, I guess, the income test threshold to a point where you're no longer entitled to the age pension, you can actually now have your pension suspended rather than cancelled for up to 2 years if that happens. Now, why that can be such a good thing, I've seen it happen before where folks are retired and then they re-enter the workforce and earn some income, and all of a sudden it knocks them out in terms of their entitlement to the age pension. Typically in a situation like that, as soon as it knocks you out for the age pension, once you come back into a situation where you're eligible again, you've got to reapply and go back to square one and kind of apply for the age pension as a new age pensioner. Whereas now what the government's saying is, look, if you do go above that threshold, we can just press pause and suspend it. All of the other benefits like the concession cards, etc., that come with it, you can maintain those, you can keep those. And then as soon as your income comes back underneath the thresholds, we can just turn the tap back on. Much more convenient and streamlined way to do things. It makes a lot of sense. And so they've basically said, look, that opportunity will be there to suspend your pension for up to 2 years, which again just means less hassle. It's always a hassle having to apply for something with Centrelink. It just kind of knocks out a lot of those issues for folks that do, re-enter the workforce, even if it's just for a limited period of time after they think they might have retired. Okay. Now, some folks are not able to get the age pension because of their income or asset position. I always say it's a great problem to have. But when that applies to you, you can still get potentially the Commonwealth Seniors Health Card. Now, the Commonwealth Seniors Health Card is basically a benefit that Centrelink provides you where you can take advantage of cheaper pharmaceuticals and a few other things. It's a great thing to take advantage of. Now, up until recently, it's been subject to an income test. So it doesn't matter what your assets are, but Centrelink will look at your taxable income. So previously, if you're a couple and your income is above $98,000 for the year, well, Centrelink would say, sorry, but your income position is too high for us to give you this benefit. Similarly, if you're a single, 61,000 was the threshold, and those thresholds moved up bit by bit each year. The announcement last night was made that those thresholds are going to be increasing, quite significantly. You can see on the right-hand side of the screen there, for a single, the new limit's now $90,000 of income for the year, and for a couple, it's $144,000. So it's a significant increase, almost 50%, which is basically going to open up the opportunity to get this to a lot more Australians, which is great. You can see the bottom line there. Obviously, any couples that are separated by illness, if somebody's in care and somebody's still in the family home or something like that, then there's slightly different thresholds there as well. But again, the increase to those thresholds is kind of uniform across the board to those three different scenarios. So again, a good little opportunity to take advantage of. If you are of age pension age, but you're not entitled to the age pension, but you think this might be something you can take advantage of, or it might apply to you, I dare say your advisor would be talking to you about it when you next sit down. But if it's not something you've discussed and you want to, I'd definitely raise it ASAP. The only other point of note for folks that receive the age pension is that the cost of medication under the pharmaceutical benefits scheme is also going to be decreasing a little bit as well. So, which is a good thing there. Okay, well, that was the majority of stuff. Oh, sorry, that was all of the stuff that I wanted to run through in terms of the meaningful changes to the budget last night. A couple of other, I guess, one other general comment that I will make is that in the budget papers, the government always forecasts, their expenses and their revenues and things like that, and the government obviously carries a bit of debt, and they've got an assumed interest rate that they apply to their debt on their balance sheets and their financials, and the assumed rate of interest that they've applied from next year is 3.35%. Why that's interesting is that the Reserve Bank's cash rate is currently 2.6%. So they're assuming in their papers that there's going to be another 3 rate increases from the Reserve Bank. We read and see a lot of commentary, and a lot of it's consistently saying that there's an expectation that we might see another 1 or 2 interest rate increases from the RBA, but because inflation's starting to slow down, and again, the government's forecasting that that'll peak by December this year. The RBA is playing a bit of a wait and see game with that. So my guess is the government's probably overestimating that a little bit just to be safe, and also in case it doesn't get that far, then they'll also save a bit of money and it'll make the budget papers look a bit better next year. So, well, I guess we'll wait and see with that. But that was the other observation that I made last night that I thought it was an interesting one to note. So, might leave it there. We will be sending out just a communication to everyone following up from today. We've recorded this as well, so if you do want to have get your hands on that, we should be able to share that around. Please feel free to come back to us if you've got any questions. Talk to your advisor. We'll definitely be talking to everyone about what's relevant to them when we next have our next review meetings, and obviously be reaching out before then if there's something we really need to be talking about sooner rather than later. But otherwise, thanks everyone for taking the time to jump on today. I hope it's been helpful, and look forward to chatting soon. Thanks very much.